All right, let's talk about the restaurant business. You know, it's a brutal, crowded battlefield, right? Margins are razor thin, competition is just fierce, and what people want to eat is always changing. Honestly, in that world, just staying in business is a huge win. But there's one company that isn't just surviving, nope, it's absolutely dominating.
So it really makes you wonder, right? How in the world, in an industry that's famous for restaurants failing, has Texas Roadhouse managed to consistently crush its rivals year after year? If you're looking at this from an investor's point of view, figuring this out, well, that's everything.
Okay, let's just get straight to the craziest number on the board. We're talking about average unit volume, or AUV. That's just how much money an average restaurant location brings in each year. And look at this. Texas Roadhouse is pulling in over $8 million per store. I mean, that's nearly double its closest competitor, Outback. This isn't just winning. They're playing a totally different sport.
So let's peel back the layers here and really dig into the data that proves just how much they're outperforming everyone. This is section 1, winning the restaurant wars.
I mean, you look at this table, and it's basically a clean sweep, but there's one number here that tells the most important story. Check out guest traffic growth. While competitors like Bloomin' Brands, that's Outback's parent company, saw their traffic actually fall by over 4%, Texas Roadhouse grew theirs by a positive 4.4%. Think about that. They weren't just jacking up prices to make their sales look good, they were physically getting more people to walk through their doors. And this right here gets to the absolute heart of it, especially if you're an investor in this space. Look, anybody can raise menu prices to boost their sales numbers, but you can't fake traffic. Growing the actual number of butts in seats, that's the clearest sign you have of a healthy brand that is actively stealing customers from everyone else. Okay, so that naturally leads us to section 2. We've seen what's happening, now let's talk about how they're doing it. What's the secret recipe behind these incredible numbers? This is the Outperformance Playbook. So the whole thing really boils down to this one core idea, the Managing Partner Program. It's pretty revolutionary, actually. Instead of just being employees, the general managers of each restaurant are treated like true partners. Yeah, they get a base salary, but here's the kicker. They also get a real cut of their restaurant's profits. This simple but super powerful idea changes everything. It creates a true ownership mentality right there on the front lines. And you can see how this creates this incredible virtuous cycle, right? When a manager feels like an owner, they start obsessing over things. They're watching every penny, making sure service is top-notch because it's their money on the line. And that obsession, it leads to happier customers. Customers who come back again and again. That drives loyalty, and you guessed it, that all-important traffic growth. And of course, that boosts the store's profits, which puts more money right back into the manager's pocket. It's just a brilliant self-reinforcing system. So what's the big takeaway here? All of this amazing operational excellence allows Texas Roadhouse to deliver on what value really means today. It's not just about being cheap anymore. I mean, think about it. Even fast food is getting crazy expensive. So people are looking for the whole package, a great experience, genuine hospitality, and a price that feels fair. Texas Roadhouse absolutely nails that combination. And that, my friends, is why they're winning. All right, so you've got this incredible operational machine. But how does that actually translate into real value for shareholders? That brings us to section 3, the financial payoff. I mean, just look at this track record. We're talking about relentless compounding growth. Even after navigating a global pandemic and insane inflation, their revenue has been growing at about 14% a year. It's gone from under $3 billion back in 2019 to well over $5 billion today. This is the kind of consistent, powerful growth that investors dream about finding. But you know, revenue is only part of the picture. For me, the ultimate measure of a truly high-quality business is something called return on invested capital, or ROIC. It basically tells you how good a company is at turning every dollar it invests back into cold, hard profit. And for Texas Roadhouse, that number is an absolutely incredible 21.4%. And to really put that number into perspective, just look at the competition. Darden, which is a very well-run company, they're sitting at 13.6%. Bloomin' Brands is barely over 4%. An ROIC north of 21% isn't just good, it's elite. It is stone-cold proof that this business model is just a fundamentally better engine for creating value for shareholders. And what they do with all the cash this engine spits out is just incredibly disciplined. They put money back into the business to keep the restaurants looking great. They fund smart new restaurant growth, no crazy expansion plans here. And then they return the rest to shareholders through bigger and bigger dividends and buying back their own stock. It's a textbook, balanced, shareholder-friendly playbook.
Okay, so the core business is a cash machine, but where does the growth go from here? That's what we'll cover in Section 4, Growth Beyond the Stake. We're going to look at the runway for future expansion. So while the main Texas Roadhouse brand definitely still has room to grow, the real excitement for the future might lie somewhere else. Look at this mix. You've got these two other brands, Bubba's 33 and Jaggers. Right now, they're just a tiny fraction of the total restaurant count, which represents a massive, and I mean massive, untapped opportunity.
You can think of these two brands as the company's growth engines for the future. You have Bubba's 33, which is their take on a sports bar, and then Jaggers, which is a fast casual spot for things like burgers and chicken. By carefully growing these, the company is basically building a very, very long runway for new restaurant development for years, maybe even decades to come. Which brings us to our final and maybe most critical section from an investor's perspective, Section 5, the price of admission. We know it's an incredible company, but is it trading at a fair price? And when you look at the valuation numbers, it's pretty clear the market knows this is a special company. It doesn't matter if you're looking at the EV to EBITDA multiple or the classic PE ratio. Texas Roadhouse trades at a big premium compared to all its peers. There's no getting around it. You're paying up for this kind of quality. And paying that premium comes with its own set of risks, for sure. This is still a restaurant, so it's sensitive to a bad economy. You've got inflation on things like beef and labor, which is a constant battle. And honestly, just maintaining this level of incredible execution as they get bigger and bigger is a huge challenge. And of course, there's the valuation risk itself. When a stock is priced for perfection, there's very little room for error. And so that leaves us with the final, big picture question. There's no doubt Texas Roadhouse is a best-in-class operator. They've got a powerful, unique business model and a long runway for growth. But the market knows it, and it prices the stock accordingly. So for any potential investor, it really all boils down to this one thing. Is this level of consistent, predictable excellence actually worth paying that premium for? Well, that's for you to decide.